You trust your bank. You work hard, save carefully, and put your money in what feels like the safest place possible. But what if I told you that your money isn't really sitting there, that it's not even safe from inflation, and that if every customer went to withdraw their savings today, there wouldn't be enough money to go around? This isn't a conspiracy. This is how the system works. Let me explain. The myth of the bank vault. Most people still imagine banks as giant vaults where their cash is held securely. You put your money in. They store it for you. You take it out when you need it. But the truth is, banks are not storage facilities. They're lending machines. Here's what really happens. When you deposit $10,000 into your account, the bank doesn't keep $10,000 for you. They're allowed, by law, to keep only a fraction of it in reserve. This system is called fractional reserve banking. In the US and many other countries, that reserve ratio can be as low as 0% to 10%. That means if a bank has $1 billion in deposits, they might only have $50, $100 million physically available. The rest, it's loaned out to people buying homes, cars, starting businesses, or maxing out credit cards. And it doesn't stop there. The money gets borrowed, spent, deposited into another bank, then loaned out again. Your single deposit could be multiplied several times across the system. This creates what economists call money velocity. But it's really just a giant, debt-fueled loop. But here's what most people miss. Each time money is reloaned and redeposited, it creates a fragile tower of IOUs. One shaky moment, an economic scare, a sudden crisis, and that entire tower can collapse. This is what happened during the 2008 financial crisis. Banks were over-leveraged. Loans went bad. Panic spread. People rushed to pull their money out, and some banks failed overnight. So, what if everyone wants their money back at the same time? Simple. The bank collapses. That's a bank run. And it's not just theoretical. This has happened many times in history, from the Great Depression to Silicon Valley Bank in 2023. Inflation, the invisible thief. Even if the money was sitting there untouched, guess what? You're still losing value every day. Why? Inflation. Inflation is when prices go up over time and the value of your currency drops. In the US, the dollar has faced an average inflation of 6% to 8% in recent years. Let's say 7%. Meanwhile, most banks pay less than 1% interest on savings accounts. That means your money is shrinking by roughly 6% every single year. Here's a concrete example. If you saved $10,000 today and let it sit untouched for 5 years at 7% inflation, it would only be worth about $7,130 in real terms. You lost nearly $3,000 in purchasing power. Same money, fewer groceries, fewer liters of gas, less rent covered. And this doesn't just apply to the US dollar, euros, lira, yen, rupee. It doesn't matter. Every fiat currency in the world is slowly bleeding value because central banks keep printing money to solve economic problems, flooding the system and diluting your savings in the process. More money in circulation, each dollar is worth less. It's not robbery with a mask. It's theft with a printer. Let me show you something wild. In 1971, when the US officially left the gold standard, a loaf of bread cost around 25 cents. Today, it's over $3 in many places. That's a 100% increase just for basic food. Your money didn't grow. Prices did. The illusion of security. But wait, you might say, at least my money is safe in the bank, right? Well, let's ask, what is safe? Is it safe if you lose 30% of your money's value in 5 years? Is it safe if your bank fails during a crisis and you're locked out of your account for weeks? Is it safe if the system your money relies on is based on trust, debt, and invisible promises? No, that's not safety. That's just familiarity, the illusion of security. Imagine this. You're in a crisis. The economy tanks. Your bank limits withdrawals to $100 per day. Your bills are due. Rent is overdue. Groceries can't wait. You thought you were safe, but now you're powerless. And yet we're taught to see cash in a bank as the gold standard of financial wisdom. But real financial security means protecting value, not just digits on a screen. Real wealth doesn't sit, it works. It grows. It resists inflation. What to do instead? So what can you actually do to protect yourself? Step 1. Keep a realistic emergency fund, 3 to 6 months of living expenses in a high-yield savings account. Step 2. Move the rest into inflation-resistant assets. Let's break them down. Precious metals like gold and silver have been trusted for thousands of years. They hold intrinsic value and tend to rise when currencies fall. Exchange-traded funds, ETFs, or mutual funds offer diversified exposure to stocks, commodities, or sectors that often beat inflation over time. Commodities like oil, copper, or agricultural goods can provide a hedge during periods of rising prices. Real estate funds, or REITs, let you invest in property without buying a house. These often pay dividends and grow in value with the economy. Global diversification. Don't tie all your money to a single economy or currency. Explore assets in stable international markets. Bonus option: invest in productive skills and education. High-income skills like coding, design, finance, or even AI tools can give returns far beyond the stock market. Because at the end of the day, you are the most valuable asset in your portfolio. You don't have to become a trader or financial expert. You just need to stop standing still. Because standing still with cash is like standing on a moving sidewalk that's going backward. The system was never for you. Here's the harsh truth. The modern banking system is not designed for your benefit. It's designed to extract profit from you using your money. When you leave cash sitting in a savings account, the bank uses it to make loans. Those loans generate interest, which they keep. You get 0.5%, maybe 1%, while they make 7%, 10%, or more. Think about it this way. You give the bank $10,000. They loan it to someone at 10% and make $1,000 per year. They give you $50 as a thank you. Who's really winning here? You're literally funding their profits, while inflation quietly drains your wealth. And when you ask for your fair share, they offer a toaster, or maybe a 0.3% bonus interest if you don't touch your account. That's not finance. That's exploitation dressed in a suit. So here's the big takeaway. Keeping your money in the bank is not wrong. But keeping all your money in the bank is financially dangerous. Inflation, fractional reserves, and blind trust in the system can quietly strip away everything you've worked for. The banks won't warn you. The system won't protect you. But you can protect yourself by being proactive, informed, and intentional. Don't let your money sleep. Make it work. Make it grow. Make it free you, not trap you. If this helped you see things differently, drop a comment and we'll answer your questions. Subscribe for more honest finance content, and remember, smart money doesn't sit, it moves.